Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Sometimes I think the surest sign that intelligent life exists elsewhere in the universe is that none of it has tried to contact us. The main difference between you and a computer is that you can be blamed for your mistakes. Dilbert, meetings are an addictive, highly self-indulgent activity that corporations mistakenly treat as work. The nice thing about cynicism is that it feels like wisdom. Doing nothing is very hard to do. You never know when you're finished.
US money supply just hit another all-time high, about $22.4 trillion. And the trend is almost comically stable. Roughly 6 to 7% growth per year since 1959. Recessions, wars, crises, new frameworks, does not matter. This line keeps climbing. This isn't a stimulus story anymore, it's a system design feature. Liquidity never really leaves, it just changes speed. Which is why asset prices levitate, cash quietly erodes, and temporary expansion somehow become permanent. Here's the uncomfortable math. RBI's liabilities are in rupees, but its assets sit in US dollars and gold. So when the rupee weakens, the balance sheet magically fattens. That's why forex gains, not spot FX moves, drive RBI's profits and dividends. Now run through the experiment. INR at 90 to 95, gold at $5,000. On paper, RBI could book massive valuation gains. Could that mean a 5 lakh crore dividend someday? Covering 40 to 50% of government borrowing. Theoretically, yes. Practically, central banks don't like turning FX volatility into fiscal policy. Tempting incentive, dangerous precedent. Japan at 227%, the US at 129%, Europe casually triple digits, and somehow markets are still functioning. That's this chart. Debt to GDP stopped being a red flag and became a lifestyle choice. The real driver isn't how much debt you have, but who owns it, what currency it is in, and whether your central bank has credibility. That's why Germany looks boring, Japan looks impossible, and India at 81% still gets lectured despite growing faster than most. India's state oil firms are back in the cash machine mode. With low crude prices, discounted Russian barrels, juicy refining margins, and pump prices staying firm, FY 2026 dividends could jump to 22,000 crores to 23,000 crores, led by IOCL and BPCL. Yes, Washington is watching Russian imports, but as long as barrels arrive cheap and margins stay wide, cash keeps flowing upstream to the government. Energy geopolitics are outside, dividend arithmetic inside. After last year's slowdown, India's credit engine is humming again. 14.5% growth and counting. That's not a boom, it's a healthy stride. Well above the 10-year average and a far cry from the post-NPA hangover. Credit growth usually shows up in earnings with a lag, so this sets the base for a broader corporate recovery, especially outside finance. It's normalization and not excess. And that's exactly why markets like it. India's industrial output just hit an all-time high. December IIP jumped 7.8%, the fastest in 26 months, and this time all engines fired, manufacturing, power and mining. This isn't a base effect cameo. Consumer demand held up, infrastructure spending stayed aggressive, inflation cooled, and policy tailwinds from GST rationalization to earlier rate cuts finally showed up in hard data. Breadth matters, and this print had it.